Hey, everybody. Thanks for joining me for my weekly live stream, my Business Booster broadcast. This week, I'm going to be talking about a topic that is kind of taboo. So there's a few taboo topics in life. Religion is one, politics is another, COVID vaccination status is a third one, and a long time taboo status is money. And I think money is something that we don't talk enough about. I think that, there's a reason why money is private, and there's a reason why you should keep money private. But there's also a lot of things about money that we need to discuss, and we need some education. As a matter of fact, a lot of my Friday videos now I'm doing on financial lessons that we should have learned in school. And money is one of those. And today's topic is not to dive into lessons you should have learned in school per se, but some things that I think business owners should be thinking about relative to money, and some thoughts I have about how to look at it, how to look at your business in a couple of different ways, and just give you some thoughts and ideas on money. So I want to start with just in general, the information we get about money and where it comes from. So when you are a business owner, each one of us are looking at our money and we're really expecting that, hey, our CPA handles all that stuff. So I don't need to worry about it because my CPA handles money for me. By the way, guys, feel free to say hi and I'll put your name on the screen. So hi, Kathleen. Thanks for joining me. By the way, I'm producing this myself. Anna is on vacation this week. So she is, usually she's helping me put all the cool banners on the screen. And so I'm doing it on my own. We'll see how I do, but I'll be looking away a fair amount so I can click on some of this stuff. But the bottom line is money is something that we need to take some ownership in and understand about our business. And it needs to be done more often than once a year. It needs to be done more often than even once a quarter, but it shouldn't be done very frequently, like daily or even weekly. I think that monthly, you should take a look at your money and see where things are at, and you should have some very, very specific metrics. You should have some very specific things that are critical to be looking at when it comes to your money. And I think that general profitability is the most basic thing that you need to understand. Am I profitable this month? Am I profitable this quarter? And how do you figure out profitability? It's super simple. You can, depending upon how detailed you get in your business, you can just keep track in general of, hey, what did I bring in revenue and what did I spend this month? You should be tracking that monthly anyway and reconciling it, because that makes your preparation of your taxes at the end of the year a lot easier. So my recommendation is every single month, just spend an hour totaling up your receipts, taking a look at how much money did I spend this month. Let's get a shout out from Anita. Thank you, Anita. Hi, good to see you, and appreciate the thank you with the little heart emoji. So I think that what we have to think about is each month, what did we bring in this month? Now, for some of our businesses, if you're a real estate agent, it's easy. How many closings did I have? And what was my revenue on those closings? That should be pretty easy to put together. Unless you're one of my realtors where you're closing 14 deals a month. Okay, maybe you're not all doing that, but some of you. But the point is, you should very easily be able to calculate, hey, how much revenue did I bring in this month? And what did I spend? Now, you got to be realistic about your spend, but you don't have to be super critically detailed. You can ballpark the numbers and you say, you know what? I spent about X number of dollars in auto. You know what your expenses are with your vehicle. You're paying for your vehicle. You know what you're paying for if you have office space. You can ballpark some other numbers. Hey, I went out to lunch about 3 times a week with clients, and I spend about $25 a week in lunches. So, or per lunch, $25 per lunch. So I'm spending about $75 a week in lunches, which is about $300 a month. Sometimes when you're just looking at a monthly number, using an estimate is a lot faster and equally valuable. So I do not want you to spend too much time, unless you have a bookkeeper or an accounting department that can print you a report, or you keep your information in QuickBooks. If you choose to keep that detailed of records in QuickBooks, great, you can press a button and you can get an idea of your profitability. But you really need to understand, hey, am I profitable right now? And if not, what do I need to do to make a change? Because too often we continue acting based on emotion without having the data to prove that we're making the right moves. And it really is a big problem when it comes to money, because you figure, hey, I've got money in the bank account, I must be in good shape. But guess what? Your business can only lose money for so long before you're out of business. So cash flow is critical, but so is profitability. And so I recommend at the very least that you're running a P&L quarterly to especially again, as a realtor, there's some realtors that close, a dozen transactions a year, but they're not one every month. So a monthly P&L, oh my gosh, this month I'm in the red. But you can also look at year-to-date numbers. You can average it, or you can look quarterly. I don't want you to overanalyze it, but I want you paying more attention throughout the year to your profitability, because you can adjust what you're spending. You can adjust your expenses to match where the market is going and or where your opportunity lies, but only if you're looking at the numbers. But pick a metric. And I think that a monthly to a quarterly review of your P&L is super, super important. So I want to share with you quickly an idea of a simple profit and loss. So I'm going to share my screen here, and hold on one moment while I pull this up. So let's share this. And this is a profit and loss, and it's super simple. Basically, you just calculate your sales. Let's get rid of this little banner here. Oops, let's go here and get rid of that guy. Okay, so all you're doing is saying, hey, how much did I have in sales? If you're in a product business where you're selling products, then you subtract out what it costs you to buy the stuff. So if you're in car sales, then, hey, I sold $10,000 worth of vehicles, but that vehicle cost me $6,000. So your gross profit is really that $4,000 difference. If you're a service industry, you don't have a cost of sales. You simply have, because in a service industry, you're not buying a product that you're turning around and selling. So your net sales, your commission, your earnings is your net sales, your gross profit. And then just your expenses. What are you spending? And then what money is left over? Don't forget income taxes. That is a big one that a lot of people, small business owners, don't account for, is you need to be setting aside money for taxes. And when you look at how profitable I am so far this year, you have to look at how much money you have left over after paying taxes. So again, super basic overview, but I think a lot of people don't know how to even look at these numbers. And you're simply saying, I brought in $10,000. I spent $4,000 in expenses this month. Therefore, my profit is $6,000. Oh, wait, I owe the IRS $1,000. So therefore, my profit is really $5,000. That's what's critical when we look at these numbers, is to simply understand where all the money is coming from and where all the money is going. Awareness is the first step. And that's really my biggest encouragement as I talk today about money, is be aware of your money. Okay. Speaking of being aware of your money, I think you need to be aware of where your personal money is going as well. And I did a class, maybe back in May, early June, on personal budgeting and where your money goes. I'm not going to go into personal budgeting right now, but I'm going to give you a real basic idea of what this looks like. So this is your personal family budget. And basically what you do is you put all of the money in column 5 that comes into your personal bank account. Now, if you have a personal and business account separate, you would only do the personal account. If you have a combined account, you'd put everything on here. And you're basically saying, hey, this is how much money I brought in. This is how much money I wrote checks for. So for all of these categories, gasoline, water, yard maintenance, etc. And you're just tracking this on a monthly basis. But the cool thing about this is you're now able to compare how much is your minimum monthly owed amount. I call that the survival number, because look, we've got to pay to survive. And yeah, you can skip a mortgage payment, but you can't really survive without having a home. And so don't skip your mortgage payment. So that's part of your survival number. But maybe eating out. If things got tight, you don't have to eat out. Maybe paying for leads from a particular lead source. I'm spending this money. I don't have to. I can be flexible in not spending money on that. And so you wouldn't put that in your minimum monthly owed, but you would put it in how much money you paid out that particular month. And then you're tracking how much money you saved that month. So, hey, did I pay extra on my mortgage? The extra $1,000 you paid on your mortgage, that's money saved. Debt paid off is money saved. Again, I go into this like an hour-long presentation on budgeting and how all of this works from a personal perspective. So I'm not really getting into that today. But the idea is I do this monthly for myself, and I track how much money I have in total. How much money have I saved so far this year? What's my net worth on how much money I have in all of my different assets? And then how much money have I given away? Now, for some people, charity is super, super important to them. For other people, it's not. So it's really a personal decision as far as giving, but it's something that you want to pay attention to. Too much that is given, much is expected. And I think that in this case, what we're looking at is how do we give back to people? And sometimes giving is just, helping out a family member who needs help with their mortgage payment this month. There's lots of ways to give. I'm not going to go too deep into that, but I do just want to share, when you think about money, make sure you're paying attention to the difference between your business money and your personal money, because a lot of small business owners, they combine those together. And you just want to be able to pay attention and say, how healthy is the business? What money is coming in and out of the business and what's left over? And then how healthy is my personal money? Do I have some bad habits? This form that I just showed you is called a personal family budget. The truth is, most people cringe when they hear the word budget. To me, a budget doesn't need to be a spending cap. It's simply a recap of what you spent so that you're looking at, hey, where am I off? If I'm not aware of where my money went, then I have no way to make changes down the road if I feel it's appropriate. Now, don't feel like you have to be limited. Don't feel like you have to answer to somebody. You're really just answering to yourself by staring at the truth. And sometimes when you stare in the mirror, you're happy with what you see. Sometimes when you stare in the mirror, you're not so happy with what you see. But the critical thing for me is having awareness of what you're looking at and what money you have. What is your real net worth? How much money? And by the way, there's a big difference between cash net worth and total net worth. And it really comes to the term being house poor. We've all heard the term house poor. So John, how does house poor apply here? Because you could have $1 million in net worth, but only have $1,000 in cash net worth. Because you have a home that's worth $1 million, it's paid off free and clear, but you only have $1,000 in the bank. You're in trouble. You might not be able to pay your property taxes, and you could lose that $1 million home because you don't have enough cash to make ends meet, to pay the bills, to operate. And so operating cash is very, very different. In business, you got to think operating cash compared with profitability. In your personal life, you have to think about cash net worth or liquid net worth versus total net worth. Because if there's a huge imbalance, that's where maybe debt comes into play as a good thing. Sometimes borrowing money to have cash is actually worthwhile. Now, I'm not telling you to go out and get a mortgage. Maybe it's a home equity line of credit. Maybe it's you don't have to owe the money, but you have the ability to tap into it. Now you have some available cash as part of the line of credit that you've established. There's a lot of ways to build available cash, but you need to be thinking about that with your personal budget. You also need to be thinking about that with your professional budget. And the way you look at that with your business is you look at that through what's called your balance sheet. So let's talk about the balance sheet really quick. Again, super scary terms. People are concerned about, John, I don't like this stuff, or my CPA handles it. Guys, this is super simple. And you've got to take some ownership in your business and in how things operate and what the numbers look like. Using the ostrich approach of sticking your head in the sand and hoping that things are okay, hope is not a strategy. So pay attention to the numbers, because this is what causes more small businesses to fail, is issues with their balance sheets. So your balance sheet is three things. It's assets, it's liabilities, and it's owner's equity. So let's talk about those three things a little bit. So your assets, let's go over here. Your assets on your balance sheet, any money that you have, whether it be in cash or whether it be in physical assets. I've got a vehicle, I've got equipment, I've got inventory, I've got investments, I've got bank accounts, whatever it is, those are all your assets for your business. So you add up all those assets and you go, hey, I've got $50,000 of assets in my business. Then you say, what are my liabilities? How much money do I owe? So what credit card debt do I have? Accounts payable. So you have, again, for most small businesses, that's your credit card. Hey, I charged something and now I got to pay it. That's my accounts payable. If you have employees, then accrued payroll, money that you have to pay in payroll can be included in there. That gets a little more complicated. But very simply, just look at your debt load. Look at how much business debt you are carrying. And then the third component of a balance sheet is owner's equity. And it's simply the difference between your cash and your liabilities. Let me super simplify this for you to give you a real basic understanding, because I think a lot of business owners are intimidated by the balance sheet. They don't understand how to think about it. And so I'm going to give you a simple thought process to go through. So the moment you created your business and you said, you know what, I'm going to become a strawberry farmer and I'm going to sell strawberries. Perfect. All right. So the first thing I have to do is I have to buy some land to grow the strawberries on. So I'm going to take $100,000 out of my personal money as the business owner, and I'm going to deposit it in the business bank account so that I can spend money buying that land. So my assets are $100,000 in the bank account and my liabilities are zero. I owe nothing to anybody. My owner's equity is assets, 100,000 minus liabilities is zero equals the $100,000. Now, why do I have owner's equity of $100,000? Because the owner invested $100,000 into the business. That's my equity in the business. Now, I spend 50,000 of that money buying some land. Yeah, it's a really small piece of land in the middle of nowhere, okay? But I spent 50 grand of my 100 buying land. I still have $100,000 in assets because now my assets are two places. They're in the land that I own of 50,000 plus the bank account that I have of 50,000. Therefore, I have 100,000 in assets, no liabilities. My owner's equity is still my $100,000 because I just moved money from one asset, the bank account, to another asset, the land. Now, 5 years from now, that land has gone up in value and it's now worth $150,000 instead of 50. Then I've got, if pretend I never ran my business, never had any money going in or out, I just kind of stopped right there and said, forget it. Then I now have assets of $50,000 in the bank, value of land, $150,000 is $200,000 in total assets. Minus liabilities of zero equals 200,000 in owner's equity. Because as the sole proprietor, whatever value is in the assets of the business really is mine. But then I say, you know what? I want to go ahead and buy a bigger piece of land. And I'm going to trade in the land that I have right now worth 150 grand. And I'm going to buy a piece of land worth 250 grand. But I don't want to use my own money. So I'm going to get a loan for $100,000. So now I have an asset of $250,000 plus I have the $50,000 cash in the bank. That's $300,000 of assets. But now I have a liability of $100,000. That $100,000 increase in assets was offset by a $100,000 increase in liabilities. My owner's equity hasn't changed. When I borrowed $100,000 to buy that extra $100,000 more valuable piece of property, it didn't change my owner's equity because I simply added to my debts. I added to my liabilities. Guys, the math is that simple. So when you look at your balance sheet, a lot of people say balance sheets don't matter. Balance sheet gives you a really good view of the health of your business big picture. You don't want to be illiquid. You don't want to be upside down where you have significantly more liabilities than you do assets. But the truth is, it's okay as long as you have a plan. Most small businesses start out upside down. Hey, I'm going to go get a SBA loan, a small business administration loan, to buy the equipment that I need to do my business. And so you're going to go do that. And you're going to borrow a whole bunch of money. You're going to put some of your own assets in there and you're going to spend that money. And you're going to have a whole lot of debt, not a lot of assets, and potentially negative owner's equity. That's because you're building sweat equity. You're building your equity in the business through the hard work that you're putting in right now. It's just not showing up yet on paper. That's okay. That's a normal process of building a business. And sometimes a healthy business ends up moving backwards a little bit. I can tell you that a lot of mortgage companies right now are losing a lot of money. That doesn't make it a bad business. It just means the market cycle that we're in right now is one that we're not making a whole bunch of profit. As a matter of fact, for the most part, most mortgage companies are making zero profit. It's a matter of, are they prepared? Was their balance sheet healthy enough to weather the storm? I'll give you another very, very specific example of this. It's builders, new construction homes. I was just listening to the podcast the other day with a gentleman named John Burns. He owns a consulting company that has been in the nation providing real estate consulting to across the nation for the last 25 years. And John Burns was talking about builders and what builders are doing right now. And they said builders have been super smart, the big builders, because they were preparing for the downturn. I don't even want to use the word downturn. They're preparing for the slowdown in the number of buyers that want to buy as interest rates have moved up. And they've been preparing for it for a couple of years. And what did they do? They took out bond loans. They took out a lot of debt. They borrowed money when rates were low. So they added to their liabilities, but they also then used that money they borrowed and kept it in the bank as cash. So they have a bunch of cash in the bank and they have a bunch of debt, but their interest rate is super low because they borrowed it 2 years ago when rates were super, super low. Now they're prepared. They own a lot of land and they're prepared to sell homes and they don't need to make as much profit. Their model right now is actually one of, as long as we're not losing money or not losing too much money, we have a lot of assets in the bank to weather this storm, even if we lost money on every home. What we're maintaining is our infrastructure because they learned their lesson back in 2008. When they shut down building back in 2008, builders lost their workforce. A lot of people said, you know what, never again. I'm going to go do something else because I cannot trust an industry that literally shut down and decimated us for years. I can't stay in that industry. I can't risk my financial future and my family's financial future on an industry that isn't trying to keep us employed, or at least trying to keep some of us employed. And so builders have seen this shift coming and they've bulked up their assets so that they can keep their workers working. If they can keep their workers working and keep business flowing, then when things turn around, then they're going to be in a position where they can turn on the spigot again very, very quickly and start building homes a lot faster because they've kept their workforce. So that's a little bit of insight on what's happening in the real estate and mortgage market, sparsed into a lesson on money. And the key lesson here is sometimes it's okay, sometimes it's necessary to lose money in the short term in order to be better positioned in the long term. So guys, I have a couple other things I want to talk about. I've got about 5 or 7 minutes left. But I want to ask, put out there, if you have any questions right now, if you're watching live, post them on comments, any comments, and I'll pull them up on screen. If you just have some thoughts that you want to, give me some feedback on, hey, John, I really appreciated you sharing X, Y, and Z. I'd love to hear that. I do want to talk a little bit about money when it comes to debt and interest and return on investment. So I'm going to start with return on investment. I think too many business owners, A, don't understand the term return on investment, and B, they just focus on, hey, as long as I didn't lose money, I'm fine. But there's a big thing called opportunity cost. Opportunity cost is, where did I put my resources that I could have put somewhere else? And so I have people who say, hey, John, I bought leads from Zillow. That's a good example for realtors and that have been looking for ways to grow their business. And so they bought leads from Zillow. And those realtors are going to turn around. Actually, hold on real quick here. Joe said, can I share those spreadsheet samples? Yes, Joe, I would be happy to. As a matter of fact, I will post in comments with a link to those samples so that you can take a look at them. So I appreciate that. So guys, when you think about return on investment and you say, I'm going to buy leads from Zillow and I'm going to spend $5,000 a month in Zillow leads. And as long as I get one closing that pays me $5,000, then I haven't lost money. And therefore, it's a fair return on investment. That's the wrong way of thinking about it. Because being in business, we're taking the risk of losing it all. We have no safety net. We have no guaranteed paycheck. We have nothing except risk. And what's the only reason to take significant risk? To have significant reward. And you got to take the good times with the bad, but don't focus on, oh my gosh, as long as I break even, I'm fine. Return on investment should be a multiple. You should be saying, hey, it's worth spending $5,000 a month in Zillow if I can reasonably expect to make $15,000 a month in revenue from that $5,000. But if you're only making $5,000 a month, even if you broke even, you just spent a lot of time working for nothing. It's kind of like going and working for a job for somebody else and saying, hey, I'll come to work for you. And as long as you pay for my gas to get to there and you pay for my lunch while I'm there, then you don't have to pay me anything else because at least I'm not losing money. You just spent a day working for that person. You're supposed to make money. And as business owners, we have that a little bit off, and we think, oh, well, it's our business. And so it's, for the long term, we're going to make the money. Guess what the long term is made up of? Many, many short terms added together. If you never make money in the short term, you can't make money in the long term. So return on investment is a critical concept that I'm not going real deep on, but I want you thinking about it. Where am I spending my money? And am I really getting value from that or not? Don't be afraid to stop spending the money, because fear is actually the number one reason why people don't trim expenses. Well, I'm not sure where my business is coming from, and I'm spending the $5,000 a month in Zillow, and I don't think I'm getting any business from it, but I can't be sure that I'm not. And so I'm afraid to stop spending it just in case. And so I'm just going to keep spending money on Zillow. And that's the wrong way to think. You've got to have a multiple on your return on investment. Okay. All right. The last thing I'm going to talk about is kind of what's going on with interest rates right now. So it is 156 on Wednesday, the 27th. The Federal Reserve just met, and the Federal Reserve just raised interest rates another 0.75%. Everybody has been worried about this and worried about what's going to happen with interest rates, and the cost of money is going to skyrocket, and we're going to see even more inflation. And guess what? We're seeing the exact opposite right now, and it's playing out exactly as we expected. And a lot of people are asking me questions, so I thought I'd take a moment while I have about a dozen of you on here right now to share with you. The Fed's job is to raise interest rates to fight inflation. I'm going to call that the medicine. The medicine is working. The Fed is giving us the proper amount of medicine, and we're digesting it properly. The stock market liked the Fed increase today. They also liked some of the things the Fed said about, hey, we're seeing some recessionary concerns, and that the recessionary concerns are leading us to think we don't have to raise rates as much as we want or as long as we want. The stock market's already figured that out, and they're super happy that the Fed is actually agreeing with that statement. And so things are going well, and things are going where they should go. But don't get complacent. We're going to see a lot more volatility. I think we probably have seen the highest interest rates we're going to see on a mortgage in this cycle, I think, based on the numbers I'm looking at. But the fact is that doesn't mean they're not going to go higher than they are today. They're down some from their high. We're going to continue to see inflation be really high through the end of the year, in my opinion. So we're going to see a lot of ups and downs. We're going to see a lot of volatility. Don't get complacent. If you need to borrow money, be smart about it. If you need advice, that is what I'm here for. I want to help guide you. I want to help lead you. And I'm looking forward to taking great care of you and your clients. So if we don't have any other questions, guys, I really appreciate you joining me today. I hope everybody has an absolutely amazing rest of the week, and we'll talk to y'all soon. Bye-bye.